No one wants to pay taxes, especially on their investments. Tax on investment income or gains can quickly chip away at your returns. The good news is that by embracing tax-efficient investing, you can reduce your tax obligations and optimize your after-tax gains. Hi, my name is Caroline Maughan, and I'm a portfolio manager at Claret Asset Management. In this video, I'll show you some tax management strategies to make your portfolio more efficient so you can keep more of your money. There are three categories of tax-efficient investing strategies: tax deferral, tax reduction, and tax avoidance. Tax deferral refers to deferring the recognition of certain taxable gains until a future date. The advantage of this approach is that it gives you the opportunity to grow your returns without immediately experiencing the tax impact. The first example is limiting portfolio turnover or delaying the sale of shares of a stock to limit the realization of capital gains. Let's take the example of someone who decides to sell a stock that has a capital gain. By delaying this sale, they also postpone the taxation of the capital gain. In a progressive tax system like Canada's, where investors' tax rate increases with income, some investors prefer to defer these gains until their retirement or a future date, when they expect their marginal tax rate to be lower than it is currently. Another common strategy to defer taxes is investing in an account that permits earnings to accumulate tax-free, but requires that taxes be paid when assets are withdrawn from the account, such as Canada's RRSP. Households with different levels of income might want to consider income splitting using a spousal RRSP. In a spousal RRSP, the higher earning spouse contributes to the RRSP of the lower earning spouse, reducing their overall tax rate. This is because the higher earner gets a tax deduction for their contribution, and when the lower earner withdraws the funds later, they are taxed at their lower income tax rate. For this to work, the receiving spouse must keep the funds in their RRSP for at least 3 years. A third tax deferral strategy is called tax loss harvesting, which refers to selling securities at a loss and using the realized loss to reduce or eliminate the overall taxable gain. In Canada, capital losses can be carried back 3 years and carried forward indefinitely to apply against capital gains. But be careful, there are strict rules to follow, such as avoiding the purchase of the same or identical security within 30 calendar days before or after the sale of the asset. And don't forget that you shouldn't buy or sell securities with the sole purpose of generating a gain or a loss. For all tax optimization strategies, investment considerations should always take precedence. The second category is called tax avoidance. These strategies allow you to structure your investments in a legitimate manner to eliminate the effect of taxes. Tax avoidance should not be confused with tax evasion, which is illegal. An example of a tax avoidance strategy is holding assets in a tax-exempt account versus a taxable account, such as a TFSA. There are no taxes on interest income, Canadian dividend income, and capital gains earned in a TFSA. And unlike an RRSP, you don't have to pay tax when you withdraw from a TFSA. The third category is called tax reduction. These strategies aim to reduce the effect of taxes on your investments. An example of a tax reduction strategy is limiting your exposure to asset classes with less favorable tax characteristics, while increasing your exposure to more tax-efficient asset classes. For example, in Canada, assets that produce capital gains are generally considered to be more tax-efficient. This is because only half of the net capital gains are included in taxable income and are taxed at your marginal tax rate. Also, did you know that thanks to an agreement between Canada and the US, American dividends in an RRSP are not subject to American withholding tax? As a general rule, investments that are subject to the highest tax rate should be held in registered accounts that are tax-exempt or tax-deferred, such as a TFSA or RRSP. On the other hand, assets that are eligible for lower tax rates should be allocated to taxable accounts. If you're a Canadian investor, you might want to hold equity investments, such as Canadian dividend-paying stocks, in a taxable account to benefit from the preferred tax treatment of capital gains and dividends. And you might want to hold investments with fully taxable income, such as bonds and treasury bills, inside your registered accounts to defer or eliminate taxes. Let's not forget that various forms of investment income, including capital gains, interest income, and dividend income, are subject to different tax treatments. The rules vary depending on whether this income comes from Canadian or foreign assets and depending on the type of account in which they are held. Remember that after-tax portfolio optimization should be based on your unique financial situation, investment goals, and time horizon. A qualified portfolio manager can help you navigate the complex landscape of how investment income is taxed and create a tax-efficient investment strategy that's tailored to you. By understanding the tax implications on your investments, you can implement a strategy to retain as much of your gains as possible. The ball is in your court. For more information, visit our website at claret.ca or get in touch with us directly by clicking on the links in the description. And don't forget to click on the subscribe button below.